Vinit Bolinjkar of Ventura Securities. Vinit, good afternoon and welcome on board. Great day to talk about the markets. Look at the massive and very enthusiastic response that the market is giving to the exit poll. What can we expect in this week? How much more volatile or how much more, higher the quantum of move could be?
So, we have to see the election post exit poll rally in relation to markets a few years ago when the elections verdict were declared. And on most of the occasions, the markets have rallied upwards of 10%. In fact, in one of the years, the returns were close to 42%. So, we expect a bullish market post the announcement of numbers on Thursday. And we expect this rally to continue given the fact that there would be new policies and growth factors being presented by the Modi government. He's already prepared a 100 days charter, and with the budget expectations also being built in, I think that the market will continue to rally. Of course, there are concerns. So the challenges are the NBFC crisis. And one is that the rainfall is not timely and it could get scattered this year. But despite all these things, I think the valuations in the mid cap and the small cap segment are significantly, very low. So the outperformance chance over the next 1 year looks very bright in that space. So we believe that the small cap and mid cap, of course, selectively are the places to invest in. In the front line, the stocks that we like are HDFC Bank, State Bank, ICICI, RBL among the mid-cap banks. And among names, we have selectively bullish on Gujarat Gas, Inox and Deepak Nitrite.
Very diverse, sectors that you just mentioned. One is from a chemical space, one is from an entertainment and media space. Can you tell us what is the rationale that's making you bet on these varied kind of stocks?
Yeah, so Deepak Nitrite has got very strong levers of growth. If you compare to the other stocks also, which I know very established players like Atul Limited, you take Vinit Organics or you take Aarti Industries, Deepak Nitrite over the next few years will be considered in league with these stocks. And the margin profile, the selection of products to produce has strategically rewarded this company, and we expect very strong growth coming in over the next 2 years. In fact, we believe at current prices, the stock is barely trading at 11 times, and with very high ROC numbers expected over the next 2 years, we believe that there is a good re-rating that come in this stock. So we are expecting a 40% upside bare minimum over the next few years. And if you consider Inox Leisure, if you see, they had some issues gripping them that they did not have adequate premium properties. PVR had stolen the plot from them, and they were struggling with restructuring the advertising operations. But now they've all got their act together. Things are really firing on all cylinders, and we have very strong growth rate in F&B across advertising. Box office collections were very strong. In fact, Q1 of FY20 due to the Avengers series is going to be a blowout quarter. And for the next 2 years, I think the pipeline of content is extremely strong. So we believe that, the company which is increasing its screens by another 80-85 this year, and this rate is expected to continue. So they will over the next 3 to 4 years take the screen count from about 500, a little shade under 500 to about 800. So this is going to ensure that footfalls grow, ATB pricing continues to rise, and other revenue drivers will also kick in. So we expect this stock to perform very well, and we see another 30-40% upside over the next 15 to 18 months.
All right, okay. Can you also give us your view on valuations? Because, we've been flagging off all day some commentary coming in from CLSA, which says that the sentiment can improve going forward. However, valuations and economic reality, these are the two factors that could cap the gains, cap the upside. So give us a sense of how you are reading into the valuations, given how much several stocks and several indices have corrected in the recent past.
Yeah, so we need to be, if you see the top line, it's been a growth in quality stocks, and there we have seen the valuations get stretched. But if you compare the returns of the large cap vis-a-vis mid cap and the small cap, we believe that there is a huge opportunity in the mid cap and the small cap, and especially when you have got a robust mandate of the sort that we have got. There are a number of decisions that the government could not take due to not being able to pass laws in the Rajya Sabha because of want of numbers. But with all virtually them possibly getting a good mandate, I think those things are a thing of the past, and regulations and passage of law will be very easy for them. And secondly, I think this will drive the growth going forward. Now, if you look at the US-China war also, I think the trade war, I think India should be a very big beneficiary, and we will be moving in very quickly to improve our exports. Also, another thing that we have to look at is that we will be having a number of potential savings on the oil bill, given the fact that we are gunning for 10 to 15% ethanol blending and raising domestic supplies. So over the next 8 years we are going to increase the domestic gas coverage to 70% of India's population and 50% of geographical area. Even if you see the data on the monthly numbers that are coming out, they are very, very robust. So all these things are going to lead to a huge macro saving, which will kind of potentially balance out the negatives that the street is trying to capture in. And to my mind, I don't think that it will have a significant bearing. So we believe that things will turn out for the positive, and we expect that the valuations are not that rich. Okay, we are still going at about average valuations.
Right. Just wanted to follow up on one of your responses, Vinit. You had said that you're bullish on a fair number of mid-cap private banks, which you had also named at the start of the interaction. Can you tell us why is it that mid-cap and small-cap private banks are looking more attractive to you? Do you see more room for growth there?
So we have one specific buyout here, that is the RBL Bank. So in RBL Bank, there are no growth concerns. So they will continue to grow upwards of 35% over the next 3 years. And this growth is going to come out of, their very differentiated lending strategy, and their focus on unsecured lending to second card holders. This market is growing very, very aggressively. They're adding almost a large number of credit card accounts, and here the yields are very high. So even if you consider a situation where the overall industry yields are going to come down, we expect that even with this assumption, we believe that RBL's yields will continue to expand. So with that kind of growth in AUM, growth in margins, profitability will see a huge bump up, and their asset quality has not deteriorated compared to the other players. So they have they're using data analytics to manage their asset quality. So we expect that the pedigree of the management to manage its risk is foremost when you are looking to buy banks, because banks are already a leverage play. So if you are able to contain risk, then you have got quality at very, very attractive valuation. So it's quoting at about 2.5 times, and with the pedigree of the management plus the growth story that is there, we believe that this stock offers decent upside over the long term.
Great, Vinit. Thank you so much for helping us understand what your perspective on the markets is.